If you start thinking like a bank, money will start working for you. In this video, I'll explain how to think like a bank in the simplest way possible. No confusing terms, no financial advice, just education to help you understand how the system really works. Section 1. Core concept. What does thinking like a bank actually mean? When people hear the word bank, they usually think of a building, an app, or a place where money is stored. But a bank is not just a place. A bank is a system designed to control the flow of money over time. Thinking like a bank does not mean being rich. It means understanding three simple things: why the system exists, why people rely on it, how money behaves inside it. Banks exist because modern economies need safe money storage, easy transactions, predictable systems. Without banks, large-scale trade and business would be chaotic. So people use banks for convenience, safety, and trust. But here's the part most people miss. Banks don't focus on money the way individuals do. Most individuals think, how much money do I have right now? Can I afford this today? Banks think, how long will this money stay in the system? How many times can it move before leaving? This difference in thinking is the foundation of everything. Section 2. System design. How the system actually works, step by step. Let's simplify this. When money enters a banking system, it rarely just sits there. Instead, it goes through layers. Step 1. Money enters the system. This could be a salary deposit, a business payment, savings moved into an account. At this point, most people think, my money is now safe. From the system's perspective, something else matters. How long will this money remain here? Step 2. Time becomes more important than amount. Banks don't rely on one person's money. They rely on patterns. If millions of people keep money parked, move it slowly. Don't withdraw everything at once. The system becomes stable and predictable. That predictability is powerful because predictable money can be planned around, modeled, used efficiently. Step 3. Control through rules, not force. The system doesn't control people directly. It controls behavior through structures, timelines, small incentives. Nothing dramatic, nothing aggressive, just quiet design. People feel like they are making free choices, but those choices happen inside a predefined framework. That's why the system doesn't need everyone to win. It only needs everyone to keep participating. Step 4. Who benefits from this design? Institutions benefit because money stays longer. Movement is predictable. Risk is spread across millions of users. Individuals often don't notice this because everything feels normal. Losses are slow, not sudden. The system feels familiar. Nothing looks broken. But the design is intentional. So the system isn't evil, and it isn't broken. It's simply built around long-term control, not short-term comfort. Most people don't lose money because they are careless. They lose awareness because the system feels ordinary. In the next part, we'll look at where people unknowingly make mistakes inside this system. Not because they're irresponsible, but because the design allows it. Section 3. Common mistakes. Where most people lose without realizing it. Most people don't wake up one day and decide to make bad financial decisions. What actually happens is much quieter. Small actions, repeated over time, inside a system that doesn't warn you. Let's look at the most common patterns. Mistake 1. Focusing on short-term comfort. The system makes short-term comfort very easy. Easy access, quick approvals, instant results. So people naturally ask, does this help me right now? But the system is not built around now. It's built around time. When decisions are made only for short-term relief, money stays longer in the system. Decisions repeat automatically. Awareness slowly drops. Nothing feels wrong until years pass. Mistake 2. Treating normal as harmless. Most losses don't come from big mistakes. They come from normal behavior. Things people say all the time. Everyone does this. This is just how it works. It's not a big deal. And that's exactly why it works. The system doesn't depend on extreme behavior. It depends on average behavior repeated consistently. When something feels normal, people stop questioning it. Mistake 3. Confusing access with control. Many people feel powerful because they have access to money, flexible options, multiple choices. But access is not the same as control. Control means understanding timelines, understanding consequences, understanding who benefits from delay. The system gives access easily, but keeps control embedded in rules most people never read or think about. Mistake 4. Ignoring small, repeated costs. Big losses are noticeable. Small losses are invisible, tiny percentages, minor delays, small inefficiencies. Individually, they feel meaningless. But the system doesn't rely on one big event. It relies on accumulation. Over time, small costs compound, habits lock in, exit becomes harder, and because it happens slowly, people blame themselves, not the structure. Mistake 5. Assuming the system is designed for individuals. This is one of the biggest misunderstandings. The system is not designed for one person's goals, one person's timeline, one person's emotions, strength. It's designed for scale, millions of users, predictable behavior, stable patterns. When individuals expect personalization from a mass system, disappointment is guaranteed. Not because the system is unfair, but because it was never built that way. At this stage, most people realize something uncomfortable. I wasn't careless. I was just unaware. The system didn't trick anyone loudly. It worked quietly, through habits and assumptions. Nothing here means people are wrong for participating. Participation is normal, but awareness changes how the system feels. In the next part, we'll explore how institutions think differently, and how some people learn to operate calmly within systems instead of reacting to them. Section 4. How smart users think. Smart people avoid panic, not systems. One important shift happens when people move from confusion to understanding. They stop asking, how do I escape the system, and start asking, how does the system think? Institutions don't panic. They don't rush. They don't react emotionally. They rely on structure. This is the biggest mental difference. Mental model 1. Time is the real asset. Most individuals think in moments, this month, this bill, this situation. Institutions think in cycles, years, decades, long-term patterns. They understand that time smooths volatility, time hides small inefficiencies, time favors consistency. That's why their decisions feel slow, but their outcomes feel stable. Mental model 2. Rules matter more than motivation. People rely heavily on motivation. I'll be careful next time. I'll fix this later. I'll pay attention going forward. Institutions don't rely on motivation. They rely on policies, processes, automatic structures. Why? Because motivation is emotional. Rules are repeatable. The system assumes human behavior will be inconsistent and designs around that assumption. Mental model 3. Predictability is power. Power doesn't come from knowing the future. It comes from reducing uncertainty. Institutions don't need perfect outcomes. They need predictable ranges. That's why they care about average behavior, probability, statistical patterns. One individual choice doesn't matter much. Millions of similar choices do. This is why emotional reactions don't threaten systems, but predictable habits sustain them. Mental model 4. Discipline beats reaction. When something feels urgent, people react. When something feels routine, people ignore it. Institutions do neither. They respond according to predefined limits, acceptable risk ranges, long-term expectations. They don't ask, how does this feel right now? They ask, does this align with the model? That emotional distance is not coldness, it's clarity. Mental model 5. Systems over situations. Individuals experience money as events, a payment, a delay, a problem. Institutions experience money as flows. They don't overfocus on one event. They observe how events connect. That's why short-term shocks rarely break systems, but long-term behavior always shapes outcomes. At this point, something important becomes clear. Understanding the system doesn't require fighting it. It requires thinking at the same level it was designed. This isn't about being aggressive or clever. It's about being calm, structured, and aware. In the final part, we'll zoom out even further to see what changes when fear is replaced by logic and confusion is replaced by clarity. Seeing the system from above. When people stop reacting and start observing, something changes. Money no longer feels like a constant emergency, a source of fear, a series of surprises. Instead, it starts to feel like a structured system. The system doesn't speed up or slow down for individuals, but individuals who understand the system experience less chaos. Not because outcomes magically improve, but because expectations become realistic. What actually changes with awareness? When awareness develops, decisions feel calmer, mistakes feel understandable, not shameful, patterns become visible. People stop blaming themselves for not winning inside a system that was never designed for individual victories. They begin to see money as a flow, not a possession, a process, not a moment, a long-term structure, not a short-term test. Fear comes from uncertainty. Logic comes from understanding. Long-term control is not about power. Control does not mean dominance. It means orientation. Knowing where you are in the system, what the system rewards, what the system ignores. This perspective doesn't remove risk, it removes surprise. And removing surprise is often enough to change how people feel and how they think. Final perspective. The financial system isn't personal, it isn't emotional, and it isn't moral. It is procedural. Once people understand that, they stop taking outcomes personally and start seeing behavior and structure instead. That shift alone changes the entire relationship with money. If this helped you understand the system better, consider subscribing for more educational breakdowns like this.